So currently right now in the United States, 11,000 people reach retirement age every day. And this will continue to occur for the next 10 to 15 years. A lot of these people have saved for retirement using something known as the 4% rule. The 4% rule simply states that you can withdraw 4% every year. You can inflation adjust that withdrawal every year in a 60-40 bond portfolio, and that money should last you 30 years. So that's kind of been a rule of thumb for financial planners, and that's how people have saved for their retirement. The problem is that the real rate of return required for this relationship to hold true is 5.6%. So if you put an inflation expectation on that, you come up with something in the area of 8 to 8.5% nominal returns required for the 4% rule to work. The problem is that the S&P 500 is currently yielding 5.6%. 10-year treasuries, 2.47%. You do a weighted average return of that as if you're running a 60-40 bond portfolio, and you come up with 3.4%. That's way short of the 8 and 8.5% rule return required for the 4% rule to work. So this is a problem, and investors are really faced with 3 different choices. So A, they can work longer, and we think that's about 9 to 10 years longer. They can spend less, save more. People aren't real good about that. Or they can somehow increase their investment returns. And we think this is what this population is really relying on. They're trying to increase their investment returns. So let's think about that. What are the ways you could increase your investment returns? Well, in a traditional world, or if you're thinking about a 60-40 portfolio, which I know no one runs anymore, but for simplification purposes, we're going to talk about a 60-40 portfolio. You could increase your equity allocation. So is that a good idea now in the market when valuations aren't really screaming the buy signal? This is an equation known as the Gordon growth model, and it looks really complex, but what I want you to know is you can take the current PE, 18.5 for the S&P 500, and you can plug it into this equation, and you can come up with what the growth forecast is. So here, the G comes out to be 5.03%, and that's growth in earnings, okay? Is that realistic or is it not? Well, here's some data to help you decide. Since 1979, annualized EPS growth has been 5.5%. Since 2000, 4.6%. In the last 5 years, 2.7%. In 2015, it was 0.2% ex energy. So at our company, we think, yeah, this is a little bit unrealistic to think that growth in earnings is going to be 5.03%. So we're thinking that equities are overvalued to fairly valued right now. And if you're a retiree, this might not be a good time to increase your equity allocation. So what else could you do? Well, you can increase the yield in your bond portfolio. And we think this is really what investors have been focused on, which ties back into the awful risk-reward that I talked about in the beginning of the presentation. Here's just a graph that shows the recent 50 and 100-year bond issues, okay? In fixed income, there are 2 ways to increase your yield. You can go out in maturity, or you can take on credit risk. That's it. So, and we think that people have been doing both. So here's a really good example that people have been going out in maturity to increase yield. One of the problems with that is simply the duration on these instruments. So right now, a 30-year U.S. Treasury has a duration of about 18.5 years. If you don't know what duration is, it means that for a 100 basis point move in interest rates, you're going to have a decline in the price of the bond of 18.5%. Okay, we've had about a 100% move from the mid-2016 lows in interest rates. So I think there is, especially with retirees, I think there's this idea that you can't lose money in fixed income. And you can't if you hold the maturity to, if you hold the bond to maturity. But a lot of these people are invested in bond funds and bond ETFs, and they're really surprised when they're opening up their statements and they're seeing this. You can lose purchasing power, by the way, but the other thing you can do is take on more credit risk. And here is a graph of high yield credit spreads, which are really close to a historic low again. I mean, I think we hit the historic low in the past 20 years in 2014. But right now, high yield credit spreads are 3.45. I think the historic average is like 5.47 or something like that. So investors are clearly taking on more credit risk to increase yield. If you want to Google a really interesting example of investors taking on just, I think, unbelievable credit risk, Google PIK Toggle bond. It's a PIK Toggle bond. And if you're not familiar with this instrument, it's a bond issue that allows the issuer the ability to pay the creditor back in more bonds if it can't afford the cash coupon. So it's basically an admission when they issue the bond that we're not so creditworthy and we might not be able to pay you back, but if we can't, we'll just pay you back with more debt. And people have been buying this. I mean, if you look at the issuance of PIK Toggle bonds, they have exploded since the financial crisis. Why would anybody buy these instruments? But they do. And so that shows you that investors are truly reaching for marshmallows right now. There's a really well-known retailer, I won't tell you who it is because you can figure it out, but they're owned by a private equity firm. And in 2013, they issued a $500 million PIK Toggle bond issuance. They immediately issued themselves a special dividend to get paid. And then in 2015, they activated the toggle and the bond started trading at 30 cents on the dollar. So another thing to remember about the current market environment that we're in right now is everybody thinks, oh, corporations are so much healthier than they were pre-crisis. Wrong. Corporate debt is back up to pre-crisis levels. And the sad thing is this debt has not been used to finance growth in many cases. It's been used to repurchase shares. It's been used to issue special dividends. So we think that investors are reaching for marshmallows in the bond market. We think the companies are reaching for marshmallows. And I guess my parting piece of advice to you would be simply this. Uncle John was once asked if he could name one piece of advice for investors in one word, what would that be? And he simply said, patience. Now, if you are honest with yourself and you know you're not a patient person and you were totally that kid, because I know you all live in this area, that participated in the marshmallow experiment and you ate the marshmallow and you just don't want to admit it today, you can do this. This is my favorite picture of my uncle ever. And it's a picture of him reading the Wall Street Journal at the North Pole. So I one time asked him about his experience managing money in the Bahamas. And he said, you know, my returns got a lot better when I moved here. And I said, oh, that's interesting. Why do you think that is? And he said, well, you know, I think it's because I get the Wall Street Journal a few days later than everybody else. So when you think about that, the tendency to herd and social proofing is so powerful in the financial markets that investors can often benefit by simply removing themselves from the herd. The best investors in the world aren't usually in the financial centers like New York and London. I mean, Warren Buffett's in Omaha, Nebraska. Sir John managed money over a grocery store in the Bahamas. They have removed themselves from the herd. And so if you have trouble controlling yourself, turn off CNBC, don't look at your stocks every day, and just remove yourself from the herd.